the course that integrates aspects of the investment decision with aspects of the financing decision. We cover a definition of lease financing, reasons to consider leasing versus other forms of financing, the distinction between financial and operating leases, the financial accounting treatment of leases, the terms and structure of a lease contract, valuing financial leases, and leasing and adjusted present value. Leasing is a means by which a firm can acquire the use of an asset for a period of time without purchasing the asset outright. It is basically a rental agreement, typically extending for a year or more, and involving a series of fixed payments. Leasing is one of three basic financing methods. Those methods are purchasing with equity, borrowing and purchasing, and leasing. Now, leasing is viewed by the financial markets as a particular form of debt. We'll discuss the implications of this fact later on in this session. Here's a list of valid reasons for a firm or an individual to consider lease financing. First, lease financing may carry a lower implicit or explicit interest rate than other forms of financing. There may be an income tax advantage to leasing versus other forms of financing, or there may be some other subsidy available. Leasing can be a way to avoid the risk of technological change. That is, when you lease an asset, sometimes your commitment to that asset has a shorter term than if you were to buy the asset outright. Therefore, as technology evolves, you may be more flexible in your approach to adopting new technologies. Leasing is a way to avoid the transactions costs associated with buying and selling. Sometimes these transactions costs can be substantial, creating a clear advantage to leasing versus buying. Leasing may be a way to avoid restrictions or covenants of debt financing. That is, in debt contracts, often there is a restriction on the use of additional debt. Sometimes that restriction extends to the use of lease financing and sometimes not. If not, leasing is a way to obtain additional financing without bumping up against these restrictions. And in lease contracts, sometimes the costs of maintaining the asset are included as part of the lease payment on good terms. So maintenance costs included at a bargain or at a reasonable price may create an advantage for leasing. The issues listed on this page should be evaluated when considering a lease approach to financing. And many of these potential reasons require evaluation in terms of their cash flow implications. They also can be aspects of a lease agreement that need to be negotiated. It has been argued that leasing is a way to avoid showing more debt on the balance sheet. The idea is that if the firm were to borrow, let's say $5 million to acquire an asset, both asset and debt go up on the balance sheet. thereby increasing the firm's debt financing ratio and potentially lowering its credit rating. If the firm were to lease the asset instead, the reasoning goes, the firm could avoid both the asset and debt increases on the balance sheet and thereby avoid an increase in the debt financing ratio. However, fairly recent changes in accounting rules have reduced the opportunity for this so-called off-balance sheet financing. Hence, leasing is generally not a way to improve the balance sheet. Some people argue that leasing is a way to preserve capital, or a means to retain cash for other purposes. However, borrowing preserves cash as well, so that leasing provides no advantage over borrowing in this respect. Leasing has been proposed as a way to avoid controls on capital expenditures. One source of such controls is internal. A board of directors might act to limit capital expenditures in a particular year. Let's consider what might happen if management responds by leasing the asset to avoid the expenditure restriction. Do you think a board would consider such a tactic counter to the spirit of its policy? And therefore, do you think leasing for this purpose might be a career-limiting move? Expenditure controls might also be imposed by external sources, such as a regulatory body. Often such regulations, which can be in place in quasi-public industries such as healthcare, in the form of so-called certificate of need regulations, cover leased assets as well as purchased assets. In this case, leasing provides no way around the regulations. There are two general categories of leases: financial or capital leases and operating leases. A financial lease is a non-cancelable contractual commitment on the part of a lessee to make a series of payments to a lessor for the use of an asset. And one of the following has to apply. The lease transfers title to the lessee before the lease expires. The lease has an option to purchase the asset at a bargain. The lease period exceeds 75% of the asset life, or the asset's expected life. Or the present value of lease payments exceeds 90% of the asset value. If one or more of these conditions is met, most of the economic value of the asset is considered to be transferred to the lessee, and the lease is considered a financial lease. As we'll see, there's different accounting treatment for financial and operating leases. An operating lease is cancelable at the option of the lessee, or none of the conditions above holds. In this case, most of the economic value of the asset is viewed as being retained by the lessor. Hence, the lease is considered an operating lease. Financial and operating leases are treated differently in the accounting statements. For financial or capital leases, the leased asset is reported as a fixed asset, and the present value of future lease payments is reported as a liability. The liability might be entitled obligations under capital leases. As the lease period proceeds, or as time passes, and as the asset becomes older, both the asset value and the liability are reduced. Operating leases are simply disclosed in the footnotes to the financial statements. A lease contract will contain many terms and conditions. Below are issues dealt with in nearly all lease contracts. The contract will specify a basic lease period during which the lease is typically not cancelable. The contract will specify the timing and amounts of payments during the basic lease period. The contract will typically indicate whether the lessee has an option to renew the lease or purchase the asset at the end of the basic lease period. And the contract will have a provision for the payment of the cost of maintenance, repairs, taxes, insurance, utilities, etc. That is, the contract will spell out whether the lessee or the lessor is responsible for paying for the costs of these services. Net lease contracts are typically those in which the lessee pays, and full service or rental contracts are typically those in which the lessor pays for some or all of these services. Organizations and individuals are often presented with a choice between leasing and buying an asset. Note that there has been a prior decision by the organization or individual to acquire the asset, so that the choice of lease versus buy is actually a financing decision that arises once an investment decision has been made in the affirmative. The lease-buy decision analysis depends on determining the value of the lease. The value of a financial lease is found by comparing the financing provided by the lease to the financing provided by an equivalent loan. We compare lease financing and debt financing because leasing is a commitment for fixed payments similar to debt, and because the financial markets consider lease financing to be part of the overall debt financing of the firm. The comparison of lease and debt financing is done by discounting the lease cash flows at the net after tax and after other subsidies interest rate the firm would pay on an equivalent loan. That is, we calculate the net present value of the lease. The NPV depends on the lease cash flows. Lease cash flows include all cash flow components that are differential between the lease option and the buy option. Some common cash flow components are the lease payment, which is a cash outflow associated with the lease. The lease tax shield, or the reduction in income taxes due to the fact that the lease expense is tax deductible. The lease tax shield is a cash inflow. And the depreciation tax shield lost. If the firm leases and hence does not buy the asset, the firm does not get to record depreciation expense on its income statement, and hence does not get a tax deduction. The resulting depreciation tax shield lost is a cash outflow. The NPV also depends on the discount rate. The correct rate is the net after-tax interest rate on debt. Note that in calculating the NPV of a lease in this way, we are using the same method applied in determining the value of a guaranteed student loan for a student, and the same method applied in determining the value of a home mortgage loan compared to equity financing. That is, we are discounting the cash flows of one financing option at the interest rate on the alternative financing option. And if we find the NPV is positive, then the focal option, in this case leasing, provides more cash or adds more value to the firm. It is therefore the preferred financing option. Let's go through an example to see how to value a financial lease. In the example, the firm has decided to acquire an asset costing $200,000. The term or life of the asset is 10 years. After 10 years, the asset is assumed to have no salvage value. The lease payment is $27,000 per year and is typical in lease contracts. The payment is due at the beginning of the year. Instead of leasing the asset, the firm could buy the asset outright, and the firm would pay a debt interest rate of 10% as an alternative financing option. The firm has a marginal tax rate of 30% and will assume the effect of the tax rate occurs at the end of the year. And in this example, let's say there's no difference in operating costs depending upon whether the asset is leased or purchased. In situations where the lease contract includes the cost of maintenance or the lease payment is set to cover the cost of maintenance as well, there may be a significant difference in operating costs between leasing and buying. We're back to our financing Excel file, and I've labeled this worksheet Lease Financing Valuation. In the northwest corner of the sheet, I've indicated the data pertaining to this lease financing decision. The asset cost is $200,000. The term of the lease and the term of the asset life is 10 years. The salvage value is assumed to be zero. The annual lease payment is $27,000. The interest rate on debt financing as an alternative financing option is 10%. The firm pays a marginal tax rate of 30%. There's assumed to be no differential operating cost between the lease and the buy options. So next, I calculate the net interest rate on debt, which is 7%. I calculated that 7% by taking the debt interest rate times 1 minus the marginal tax rate. So we have an alternative financing source that the firm could use that's associated with a 7% net interest rate. Next, I calculated the annual depreciation expense on the asset if the asset were purchased by the firm. And that was simply calculated as the asset cost divided by the term or life of the asset. So we get a $20,000 per year depreciation expense. Now you can see below that I've already done the lease financing valuation process and come up with the net present value of the lease. Now let's erase this part of the worksheet and redo it so that you can see exactly how to do a lease financing valuation. In year 0, if the firm leases, the lease contract provides $200,000 in financing or $200,000 cash inflow. In each year of the lease, the firm has to make a lease payment of $27,000. That lease payment occurs at the beginning of each year, and it's a cash outflow. So I'm going to highlight cell C6 where we have our lease payment, put a negative sign in front of it, lock the cell reference by hitting F4, and then we can copy the formula or the cell reference down. So we have 10 lease payments of $27,000, and these lease payments occur at year end 0, which is the same as beginning of year 1, through year end 9, which is the same as the beginning of year 10. At the end of each year, if the firm leases the asset, the firm records its lease payment as an expense, and that expense is a tax-deductible expense. So the firm gets back from the government its lease payment times its marginal tax rate. So we can calculate the lease tax shield as equal to the lease payment that occurred at the beginning of the year. I'm going to put a minus sign in front of this to get rid of the negative lease payment, times the firm's marginal tax rate. I'm going to lock the cell reference for the tax rate. So the lease tax shield in each year is $8,100. That is to say, the firm will get back from the government $8,100 of its lease payment because of the income tax deductibility of lease expense. Now, if the firm leases instead of buying the asset, the firm does not get to record depreciation expense on its income statement. And so the firm loses the depreciation tax shield, or tax reduction. Hence, the depreciation tax shield lost is a differential cash flow between the buying and the leasing options. And we have to take it into account in our lease financing valuation. The depreciation tax shield lost is equal to the depreciation expense, and I'm going to put a minus sign in front of it because it's a negative. Lock that cell reference, times the firm's marginal tax rate. Again, lock that cell reference. So in each year, the firm loses a depreciation tax shield worth $6,000. We've accounted for all the components of the lease cash flow, and now we can calculate the net cash flow of the lease, or the lease cash flow, in each year. And that's going to be equal to the sum of the cash flows indicated in column B, C, D, and E. And we can just copy that formula down. So we have our net cash flow in each year for years 0 through 10 associated with leasing versus buying. The final step is to calculate the NPV of this stream of cash flows. So once again, let's go up and invoke the NPV function. And for our interest rate, we want to use the 7%, which is the net interest rate on debt. And for our values, we use the cash flows occurring at the end of years 1 through 10. Say OK. And then we need to go and amend the NPV function, as we've done many times before, by adding in the year 0 cash flow. And we get our net present value of the lease of $11,838. The interpretation of this positive $11,838 is that lease financing provides more cash than debt financing, or provides $11,838 more cash. Another interpretation is that lease financing increases the value of the firm by $11,838. Still another interpretation is that the interest rate implicit in the lease contract is lower than the effective interest rate on the debt financing option. Here are a few notes just to reinforce the lease financing valuation process. Note 1 is that the initial financing provided is the cost of the asset because leasing provides financing for the asset, much in the same way as borrowing provides a cash inflow. Note 2 is that there are two cash flow effects of taxes. The first is that you can deduct lease expense, so you get a tax shield, and the value of that tax shield depends on your marginal tax rate. The second is that you can't deduct depreciation expense, so you lose the depreciation tax shield because you don't own the asset. Note 3 is that the discount rate is the net after-tax interest rate on the loan that is the alternative financing source. And finally and importantly, note 4 is that the organization has done a prior investment analysis and has determined that the asset is worth purchasing. That is, that the asset is associated with a business opportunity that has a positive NPV. Next, let's consider leasing and adjusted present value. Here are some important rules. In general, we want to keep financing and investment analyses separate. But when financing and investment decisions interact, the analysis needs to reflect the effect on the value of the firm of both the investment and the financing aspects of the decision. That is, the analysis must calculate an adjusted present value, which is equal to the sum of the basic or investment net present value and the net present value of the financing caused by the project. There are actually very few situations where investment and financing decisions are tied together. Mostly, investment decisions can be made independent of specific financing sources. And financing is typically not tied to specific investments. Rather, the firm's operations are thought of as supported by a balance sheet composed of a portfolio of assets and a mix of financing sources that, taken together, support all the assets. Hence, we make investment decisions based on the cash flows of the business opportunity, discounted at a weighted average cost of capital, which reflects the overall financing cost of the firm. We make financing decisions to achieve a goal of minimizing the overall cost of financing the firm, that is, minimizing the weighted average cost of capital. But occasionally the investment and financing decisions are intimately related. They can't be disentangled. In these cases, we may have to consider an adjusted present value. One common situation where investment and financing decisions are tied together applies to not-for-profit and public firms. As an example, let's say Bozo Buffoon has become a wealthy and generous philanthropist. He approaches the university and offers to donate $50 million to support the construction of a new building for the Clown College. He says that the university can use the money only for this specific purpose. The university is now faced with an investment decision, which is build the new Clown College building or not. and the decision depends on a financing option, that is, Bozo's gift. The cash flow analysis for the university will be to determine the net present value of the construction option and then to add the $50 million gift. In doing so, the university is calculating an adjusted present value. Note that the university would not calculate an APV for this decision if Bozo had given the $50 million without constraints or strings attached. If the university could use the money in any way it saw fit, it would not consider the gift as dependent on the construction investment, and the construction decision would have to stand or fall on the business merits without the financing advantage. A second situation wherein the financing and investment decisions are often connected is in the case of lease financing. Here again, it may be necessary to calculate an adjusted present value. In a lease financing situation, a positive NPV of the lease means that if you acquire the asset, lease financing is advantageous. That is, it's less costly than debt financing. Lease financing is the preferred financing option. But a positive NPV of a lease does not mean that you should acquire the asset. In general, the asset acquisition decision depends on the investment net present value of a project. But sometimes, if the investment NPV is negative, favorable lease terms can rescue the project by creating a positive adjusted present value. Here's an example that shows how to apply adjusted present value in a lease financing situation. Assume that the net present value of acquiring the asset in the example we just went through, employing your firm's overall cost of capital of 9% after taxes, was determined to be a minus $3,000. You would therefore tentatively make the decision not to purchase the asset. But if the seller offers to lease the asset to you at the terms in the example, which imply a lower cost of financing than your typical interest rate, then the whole activity takes on a positive adjusted present value. That is, the APV equals the NPV of the project plus the NPV of the lease, or minus $3,000, which is the negative NPV of the project, plus the $11,838 NPV of the lease, for an adjusted present value of $8,838. In this example, favorable lease terms rescued a negative NPV investment project. Because the seller has essentially agreed to subsidize your acquisition of the asset, you're able to acquire the asset and still add value to your firm. So the correct decision is to proceed with the acquisition of the asset and to support that acquisition with lease financing.